Hi guys, this is CA Balakrishna from Lecturepedia.in. How are you? Hope you people are busy in your preparation and hope your preparation is going well. Now in this class we will be revising FEMA Foreign Exchange Management Act, and the purpose of this class is only revision purpose. You please don't expect explanation of the concept in this class, because in the FEMA, if I give explanation, it will take a lot of time. There will be certain terms which will take lot of time for explaining. So I'll not be explaining in this class. I will be just revising. Hope this is clear. If you want explanation, you better go for regular classes. Okay, with this let us start the revision. First of all, FEMA, what is the purpose of introducing a Foreign Exchange Management Act? Basically, every country will be having foreign exchange exchequer. In the same way, even Indian government is having a foreign exchange exchequer. Now, into this foreign exchange exchequer, foreign currency will be earned as income if you export from India. At the same way, if you import into India, expenditure in foreign currency has to be incurred from this foreign exchange exchequer. Now the aim of the government through this FEMA is to manage this foreign exchange exchequer. Now if you see the income portion, you cannot manage it because it is a long term process, because if the country develops, then the exports from that country also develops, so it takes a lot of time. Whereas expenses portion, you can manage it. If you feel like the foreign currency in the exchequer is reducing, you can put limitations on the expenditure part. So the purpose of FEMA is to manage the expenses part of foreign exchange exchequer. Hope this is clear. Now in this FEMA, for our syllabus, we can divide this FEMA into residential status. We have concept of residential status and current account transaction, capital account transaction. Then we have external commercial borrowings. After that we have overseas direct investments and provisions related to exports. You can divide this FEMA into these parts. Now first of all, we will revise residential status. I'll take you to another chart. Basically, as per FEMA, we have two types of residential statuses. One is person resident in India and another one is person resident outside India. Now you have to learn the definition of person resident in India. Once you learn the definition of person resident in India, all the persons other than person residents in India will be person residents outside India, that is PROI. Now who will be known as PRI, person resident in India? There are basically two conditions. First condition, you will check whether that person has resided in India during the preceding financial year for a period of 182 days or more or not. That is the first condition. Next condition, what you will do is, there are certain specified purposes. You will see whether that person has come to India for that specified purpose or went out of India for that specified purpose. First of all, what are those specified purposes? There are three. First one, for the purpose of employment. Second one, for the purpose of business. Third one, for any other purpose where the period is uncertain. The period of return to India is uncertain. These three are specified purposes. Now if a person goes out of India for specified purpose, then he will become PROI. If he comes to India for specified purpose, then he will become PRI. Now let us understand this with the help of an example. I'll quickly make you to go through this example. If you want a detailed explanation, there is another video of around 20 minutes. There I have explained this residential status concept very detailedly. You can find it in the I button. You can watch it from there. But now here I will quickly explain you this. Let us say there is a person Mr. A who is in India, and there is person Mr. B who is in USA. Now Mr. A is entering into transaction with Mr. B. While entering into transaction with Mr. B, Mr. A will check the residential status of Mr. B who is in USA. Now see what he will do. First of all, Mr. A will see whether Mr. B has resided in India during preceding financial year for 182 days more or not. The answer is two types of answers you get. The first one is yes or no. If yes, Mr. A, he will again see if whether Mr. B has went outside India, because Mr. B is presently in USA na. So Mr. A will see whether Mr. B went outside India for specified purpose. If Mr. B went outside India for specified purpose, then Mr. B will become person resident outside India. In case Mr. B went outside India for non-specified purpose, then Mr. B will become person resident in India only. Hope this is clear. If the answer to first question was no, even then as per ICI you have to check this. The second one also you have to check as per ICI, but practically there is a different issue that we'll deal with, that I will not explain. You need not remember that. You please remember as per ICI. Now what ICI says, even though the first condition is not satisfied, that is person has not resided in India for 182 days or more during the preceding financial year, even then you have to check whether that person has went outside India for specified purpose. Yes, he went outside India for specified purpose, then he will become person resident outside India. No, he went outside India only for non-specified purpose, then he will become person resident in India. Hope this is clear. Next, now Mr. A verified residential status of Mr. B, right? In the same way, Mr. B, who is in USA, will also verify the residential status of Mr. A. Now what Mr. B will see, whether Mr. A has resided in India during preceding financial year for 182 days or more. Again, two types of answers will come, yes or no. If it is yes, Mr. B will again check whether Mr. A went to India for specified purpose. Yes, he went to India for specified purpose. In that case, Mr. A will be person resident in India. In case he went to India for other than specified purpose, then Mr. A will be person resident outside India. If the answer to first question was no, even then Mr. B will see whether Mr. A went to India for specified purpose. Yes, he came to India for specified purpose, then Mr. A will be person resident in India. If he came to India for other than specified purpose, then Mr. A will be person resident outside India. This is how you will check if individual cases is given. However, there is another some more detailed analysis that I have given in that 20 minutes video. You can watch it for that analysis if you want to understand. Otherwise, this much will be sufficient. Next, moving to our chart. Applicability of FEMA. If you see, FEMA is applicable to whole of India, and also you should check applicability of FEMA for each transaction. Okay, for each transaction that you are entering, you have to see whether FEMA is applicable to this transaction or not. Basically, in the transaction there will be three features. First one is who is the person that is entering into transaction, where that transaction is being taking place, and in which currency that transaction is being entered. Based on these three factors, we will decide whether FEMA is applicable to that particular transaction or not. Here I have given you various scenarios. Let us understand. First column is person, next column place where the transaction is being taking place, next column is currency, next column is applicability. Let us see. Now, person resident in India is entering into a transaction in India only, and the currency in which he is entering into transaction is rupees. In that case, FEMA is not applicable, because here dollar is not involved and transaction is also in India and the person is PRI only. Then FEMA is not applicable. Next situation, person entering into transaction is PRI, but and the place of transaction is also India, but the currency in which transaction is being entered is dollars, that is foreign currency, thereby FEMA gets applicable. Hope this is clear. Next, person entering into transaction is PRI, place where transaction is being entered is outside India, and the currency, whether it may be dollar or rupee, since it is being entered outside India, FEMA gets applicable. Next, fourth situation, person entering into transaction is PROI and it is being entered in India, and whether it might be in dollar or in rupee, since PROI is involved, the FEMA gets applicable. Next, person entering into transaction is PROI and the place where the transaction is being entered is outside India, and the currency, either it might be rupee or dollar, FEMA is not applicable, because transaction entered by PROI, we are not concerned with PROI, and where he is entering the transaction, he is entering a transaction outside India. If he is entering into transaction in India, then FEMA might be applicable. But he is entering into transaction outside India. If he is entering into transaction outside India, then we are not concerned. So for those types of transaction, FEMA is not applicable. Hope this is clear. This is the applicability of FEMA. Next, moving to section number 3. Basically, section number 3 speaks about 3 aspects. First one, whenever you buy or sell foreign exchange, you need to buy or sell foreign exchange only through authorized dealer. Hope this is clear. This is the first aspect which is told by section number 3. Next, section number 3 also says that all hawala transactions are prohibited. Okay, and it also says that no person should make payment to the credit of PROI. Example, a PROI taken insurance in the Indian from an Indian company. Now, for the purpose of his insurance, some premium has to be paid now. This premium should not be paid by any Indian person. This is one of the example which is related to prohibition in paying to the credit of PROI. Hope this is clear. These 3 aspects are dealt by section number 3. After that, we have current account transaction, capital account transaction, very important. First of all, we will understand the definitions of current account and capital account transactions. First of all, capital account transaction. What are capital account transactions? Any transaction which alters assets, liabilities or contingent liabilities outside India of a person resident in India, that becomes capital account transaction. Or any transaction which alters assets or liabilities. Here contingent liabilities is not there, only assets, liabilities in India of a person resident outside India, then even that becomes capital account transaction. Hope this is clear. Moving to current account transaction. What are current account transaction? Current account transaction means any transaction other than capital account transaction but including the following. What are those following? First one, any payment related to foreign trade or repayment of loan, or any payment related to payment of interest of foreign loan, or living expenses for spouse, children and parents who are living abroad. See, they must be living abroad and on them you must be incurring some living expenses in foreign currency. And last one, medical expenditure or any expenditure related to studies of parents, spouse, children. Okay, studies related to children, medical expenditure related to spouse, parent and foreign travel expenditure. Okay, this becomes current account transaction. Now, if you see, I have already told you that the purpose of Foreign Exchange Management Act is to manage expenses portion of foreign exchange exchequer. Now, if you want to manage expenses portion, you have to keep certain restrictions on the expenditures that can be incurred in the foreign currency. Those restrictions are kept in the form of current account transaction and capital account transaction. Okay, for the purpose of imposing those restrictions, the transactions have been divided into capital account and current account as per FEMA. Now, what are the list of current account transaction? Basically, in the current account transaction, we are having 3 schedules. For current account transaction, the general rule is that all the current account transactions are permitted except prohibited. Okay, that is the general rule for current account transaction. Whereas capital account transaction, all the transactions are prohibited unless permitted. That is for capital account transaction. This is the general rules. Now, let us detailedly discuss the schedules. In the current account transactions, we have 3 schedules. Schedule 1, Schedule 2, Schedule 3. Schedule 1, all the prohibited current account transaction. Schedule 2, those transactions which can be incurred with the prior permission of central government. Schedule 3, transaction which can be incurred with prior permission of RBI. Okay. Now, schedule number 1. What are the prohibited transactions? See, lottery winnings. In India, you have taken a lottery and from that you have earned some winnings. Now, you want to transfer these winnings to foreign country in the form of foreign currency. That is prohibited. Next, you have earned in India income through racing or riding and you wanted to take it to foreign country by converting into foreign currency. Prohibited. Next, you wanted to purchase lottery tickets or band magazines or football, football lotteries or sweepstakes in foreign country, then you cannot take money from India to that foreign country for the purpose of purchasing lottery tickets or these banned magazines. Hope this is clear. Next, commission on export towards equity investment in joint venture or wholly owned subsidiary abroad of Indian companies. This transaction we have discussed for around half an hour in the regular class. Okay, I can't explain this transaction here in this class, okay, because it is revision class. If I explain the transaction, it will take a lot of time, so you remember it. Next, dividend remittance in case of dividend rebalancing is applicable. Even this dividend rebalancing is a separate concept that I can't explain it you here. Next, payment of commission on exports made through rupee state credit route. For the exports that you make through rupee state credit route, what is this rupee state credit route? Please Baba, please, I can't explain this in the revision class, okay. For those types of exports you cannot pay the commission. Basically, example is exports that you make to Russia will be coming under this aspect, okay. We have discussed this sixth point itself for around half an hour in the regular class, okay. But however, there is a exception for this. If you are exporting tea or tobacco, then commission up to 10% of value of that export invoice you can make the payment to it. Hope that is clear. That is the exception. Next, even for callback services you cannot make payment in the foreign currency. And interest income that you earn on non-resident special rupee scheme account. Basically, as of now, the Indian government is not giving any interest on this account, but since they have given here, you need to learn it. Those are the prohibited transactions. See, most of the people, they think that these transactions are prohibited even if you enter in Indian rupees. No, these transactions are prohibited only if you want to enter in foreign currency. If you want to enter in Indian currency, these are not prohibited. Hope that is clear. Next, moving to schedule number 2, where transactions, current account transactions which require permission of central government. Basically, here there are a list of some 9 transactions which require permission from various ministries. Let us see. First of all, that side remittances, this side permission. If you want to make remittance for the purpose of conducting any cultural tour, then you have to take approval of Ministry of Human Resource Development. Next, if you are giving any advertisement in foreign print media, okay, that means in foreign newspaper you are giving any advertisement and the amount of that advertisement is exceeding $10,000, then you need to take approval of Ministry of Finance and Department of Economic Affairs. However, there are exceptions to that. If that advertisement is related to promotion of tourism in India, or promotion of foreign investments into India, or promotion of international bidding, in that case you need not take that approval. Hope this is clear. Next transaction, a public sector undertaking has imported goods into India through a vessel. Now for that vessel you need to pay freight. If you want to pay that freight in the foreign currency, then you need to take approval of Ministry of Surface Transportation. Next, payment of import. The public sector undertaking or any government department has imported into India through ocean, and that import value you wanted to pay in foreign currency, then also you need to take approval of Ministry of Surface Transportation. Next, multimodal transport operators, if they want to make any payments to their agents, basically their agents will be present in various countries. If they want to make any payment to their agents, then they need to take a certificate of registration from Director General of Shipping. Now you might get a doubt, what is this multimodal transport operators? No, I can't explain it here. It will take a lot of time to explain that, so please. Next, transponder hiring charges. Basically, TV channels and internet service providers, they will have this type of expenditure. Transponder means certain type of umbrella like things you will find for telecasting the programs by the TV channels. Those are transponders. Now if you want to pay these transponder hiring charges, then you need permission of Ministry of Information and Broadcasting and Ministry of Communication. Okay, container detention charges, Ministry of Surface Transportation. Prize money exceeding $1 lakh. If you are willing to pay any prize money exceeding $1 lakh, then you need Ministry of Human Resource Development permission. However, there is a exception to this. If the prize money is being paid by any recognized sports authority like BCCA, then this permission is not required. Next, if you want to pay membership fees to P&I club, basically this P&I club is like a insurance, you can understand. For that membership fee to P&I club, you need to make payment to Ministry of Finance. Hope this is clear. These are 9 transactions for which approval of various central government ministries will be required. Hope this is clear. Next, moving to the schedule number 3. These transactions, schedule number 3, if you want to enter into these transactions, you need to take approval of Reserve Bank of India. What are those transactions? You are visiting to any foreign country, and for incurring expenditure in that country, you want to withdraw foreign exchange, then you need to take approval of Reserve Bank of India. However, if you are traveling to Nepal and Bhutan, then you will not be allowed to withdraw foreign exchange, because in those countries Indian rupee will be accepted. Next, if you want to give any gift or donation, you need RBI's approval. Next, if you are going abroad for employment or immigration, maintenance of close relatives, studies abroad, medical treatment abroad, business travel, other current account transactions, for all these schedule 3 transactions, you need approval of RBI. However, if you are spending amount less than $250,000 on these transactions, then RBI approval is not required. If you are spending amount exceeding $250,000, only then RBI approval is required. Basically, this will be coming under liberalized remittance scheme. As per liberalized remittance scheme, every individual, every person resident in India is allowed to spend up to $250,000 without permission of RBI. If you want to spend exceeding $250,000, then you need to take approval of RBI. Basically, here this schedule 3 current account transactions will be counted for that purpose of liberalized remittance scheme. And also in the capital account transaction, we will be having schedule 1, those capital account transactions permitted for a person resident India, and there are freely permissible current account transactions. Basically, apart from these 3 schedules, schedule 1, schedule 2, schedule 3, remaining all other current account transactions are freely permissible. Now these 3 will be counted for the purpose of calculating that $250,000 limit as per liberalized remittance scheme, LRS scheme. Hope this is clear. Now, however, here there are 3 transactions: immigration, study abroad, and medical treatment abroad. Transaction number 4, 6, 7. If for these 3 transactions, if you require more amount and that respective authority requires more amount, let's say for example study abroad, you are joining in some foreign university and that foreign university's fees is more than $250,000. Okay, the foreign university itself has given in its those pamphlets, their fees is more than $250,000. In that case, you will be allowed to remit more than $250,000 because the fees itself is more than $250,000. Without approval, you can do that. Even medical treatment, same. If the medical treatment requires more than $250,000 and approved by that particular medical institute which is present in abroad, then you can take more than $250,000 without approval of RBI. Okay, for these 3 transactions, that restriction, that exception is there. Hope this is clear. Next, and there is another concept here. There is a concept of resident but not permanently resident. Basically, this resident but not permanently resident means he is citizen of some other foreign country and he came to India on a employment purpose, and that employment period is not more than 3 years. In that case, he will be known as resident but not permanently resident. Now, this resident but not permanently resident person can transfer or can remit to his country the net amount of salary that he is earning in India. Net salary means salary after deducting all the deductions. Okay, that amount he can take back to his country for person resident but not permanently resident. Hope this is clear. Next, now these schedule 3 transactions we have discussed for individuals. Okay, these transactions are for individuals only. What about companies? If companies wanted to enter into these transactions, for companies there are 4 transactions they have given. For these four transactions, if the limit exceeds, there are separate limits given for each transaction. Okay, if the limit exceeds, then RBI permission is required. Hope this is clear. Let us see what are those 4 transactions in case of companies. See, transactions for other than individuals requiring RBI permission. First transaction. Now let's say in India, the Indian company, they are selling some real estate project. They have started a real estate project and they are selling some houses or whatever it might be to foreign people. They are selling. Okay, in that case, the Indian company need to appoint real estate agents, okay, who will bring buyers to that project. So for this real estate agent, the Indian company has to pay commission. Now, what is the maximum amount of commission that can be paid to such foreign real estate agent without approval of RBI? The maximum amount of commission is 5% of inward remittance. Inward remittance means the amount that buyer will bring for purchasing this property in India. Okay, 5% of that inward remittance or $25,000, whichever is higher. Okay, up to that amount you can pay as agent's commission without approval of RBI. If that amount or that limit exceeds, you need to take approval of RBI. That is the first transaction. Next, consultancy services. You might take consultancy services from foreign countries. Okay, if that consultancy service is related to infrastructure project in India, then maximum consultancy fee that can be paid without prior approval of RBI is $1 crore. If the consultancy is related to other than real estate project, then the maximum consultancy fee that can be paid is $10 lakh without approval of RBI. If it exceeds this limit, you need to take approval of RBI. Next, pre-incorporation expenditure. Basically, some foreign countries or foreign people, what they'll do is they'll come to India and they'll start some businesses in India or some companies in India. Now, for this, they will incur some pre-incorporation expenses, right, for setting in India. Now, these pre-incorporation expenses, once the company has started, they wanted to take back those pre-incorporation expenses to their country. In that case, what is the maximum amount of pre-incorporation expenses that can be taken back? See, exceeding 5% of investment brought. Let's say that particular person has brought some $1 lakh into India. Then 5% of $1 lakh means $5,000. Up to $5,000 you can take without prior approval of RBI, or 1 lakh, whichever is higher. Okay, higher of those two limits is the maximum up to which you can take back to your country as a pre-incorporation expense without approval of RBI. If it exceeds these limit, then you need to take approval of RBI. Hope this is clear. Next, donation for a creation of chairs or donation to any fund created by foreign educational institute. The maximum amount of donation that you can give is 1% of exchange earning, the foreign exchange earning that you have made during the preceding 3 financial years, or $50 lakh, whichever is lower. Hope this is clear. These are the 4 transactions related to companies, you can say. Next, this is transactions with central government permission. Next, however, if you are entering into any transaction, just a second, I'll just get my power bank. See, above we have discussed that for various transactions we require central government permission, RBI permission. But if you incur those transactions from RFC account, resident foreign currency account, or EFC account, exchange earners foreign currency account, if you are incurring expenditure from these 2 accounts, then you need not require that permission, because in these 2 accounts the amount that is available will be the foreign exchange that you have earned. So you are incurring expenditure from your own foreign exchange, so no permission is required. But however, from EFC account, if you are incurring expenditure related to membership fee of P&I club or foreign real estate agent commission, for these 2 purposes the permission is required even though you are incurring from EFC account. But generally for all other transaction, if you are incurring from EFC account and RFC account, permission is not required. Hope this is clear. Next, moving to capital account transaction. Basically in this capital account transaction, we will be having two schedules, schedule 1, schedule 2. What is the general rule of capital account transaction that I have told you? All the capital account transactions are prohibited unless permitted. So schedule 1 speaks about permitted transactions for person resident in India. Schedule 2 speaks about permitted transactions for person resident outside India. Basically most of the transactions in these two schedules are similar. Let us see. For person resident in India is allowed to make investment in foreign security, and this person can also raise foreign currency loans, and this person resident in India can also issue guarantees in favor of person resident outside India, and this person resident in India can transfer immovable property outside India, and he can also import export foreign currency notes, and he can borrow from person resident outside India, and person resident in India can maintain foreign currency accounts outside India, and person resident in India can take insurance contract from a foreign insurance company. See, here you might get confused. If in examination if you get question related to insurance, you might feel that is a current account transaction. No, insurance is a capital account transaction. Next, remit capital assets outside India and undertake derivative contracts. All these are permitted capital account transaction for person resident in India. Next, permitted capital account transaction for person resident outside India. Let us come from below. Undertake derivative contracts in India, permitted. Remit capital assets out of India, permitted. Foreign currency account in India, permitted. A person resident outside India can maintain foreign currency account in India, permitted. Next, deposits between PRI and PROI, import export foreign currency notes. See, same points repeating. Just a second. Acquisition and transfer of immovable property in India, but subject to certain conditions. There are regulations related to this issued. Subject to those conditions, it is permitted to acquire immovable asset in India. Next, investment in Indian securities. These are permitted transactions for person resident outside India. Entirely this is a capital account transaction. However, there are two such transactions for which no restriction can be imposed by government even in future. What are those two transactions? First one, payment on account of amortization of loan. You have taken a loan from some foreigner and you are repaying that loan. For that, no limit can be imposed. And depreciation of investment. You have invested in some foreign country, in a company of the foreign country, and your share capital has got eroded. In order to replace that share capital, you are again investing into that company. For these two transactions, no prohibition can be imposed in the future also. Hope this is clear. And there are 5 prohibited investments that person resident outside India cannot make in India. What are those 5 businesses? First one, chit fund business. Chit fund business, nidhi company, and agriculture or plantation activities. Any company which is involved in agriculture or plantation activities in India, in that type of companies a person resident outside India cannot invest. And also company which is involved in real estate activities, even in that company a person resident outside India cannot invest. And a company which is involved in trading of transferable development rights. This transferable development rights, hope you know the concept of transferable development rights. I am not dealing with that. Any company dealing in these 5 types of businesses, in that company person resident outside India cannot invest. Hope this is clear. Next, acquisition of immovable property outside India by person resident in India. Generally, a person resident in India can acquire immovable property outside India by way of gift or by way of inheritance from 2 persons. First one is from a person resident in India who has acquired that property prior to 8th of July 1947, or a person who has acquired that property when he was person resident outside India. From these 2 people, a person resident in India can get the property outside India as gift or as inheritance. Next, person resident in India can also purchase immovable property outside India by making the payment from resident foreign currency account. Next, a person resident in India can acquire immovable property outside India jointly with a person resident outside India, provided there is no outflow of funds from India. That means that person resident outside India has to pay the amount for that property. In that case, PRI can acquire. And there will be some Indian companies having branches or subsidiaries outside India. Those companies, for the purpose of their business, they can acquire immovable property. Hope this is clear. Next, acquisition of immovable property in India by NRI and OCI, overseas citizen of India. Basically, you have to remember that NRI and OCI cannot acquire three types of properties in India. What are they? Agricultural land, farmhouse and plantation property. These three properties NRI, OCI cannot acquire in India, but there is exception to this. What is the exception? If in case these three properties are inherited from person resident outside India who acquired it as per FEMA, or from another person resident in India. Okay, from these two people, NRI or OCI can inherit agricultural land, farmhouse, plantation property. Hope this is clear. Apart from in this situation, these three properties cannot be acquired by NRI, OCI, and all other properties apart from these three properties can be acquired by NRI by making proper payment through proper banking channels, and there is relevant inward remittance. Okay, by this way he can acquire immovable property in India other than those three properties. Or NRI or OCI can also receive immovable property other than those three properties as gift from another NRI or from another OCI or from another PRI, provided those people, PRI, OCI, NRI, or relatives of this NRI or OCI who is acquiring this property as per section 2 subsection 77 I guess of Companies Act 2013. Okay, in the Companies Act 2013 section 2 subsection 77 there is a definition of relative. As per that they should be relative. Next, transfer of immovable property. Now NRI or OCI can transfer any immovable property including those three properties, agriculture, farmhouse, plantation, including those three properties. Any property can be transferred by NRI, OCI to person resident in India. That is first case. Next, all the properties other than those three properties can be transferred to another NRI or another OCI. Hope this is clear. This is related to transfer of property. Next, a person resident outside India can purchase immovable property in India together with his NRI or OCI spouse, provided there are certain conditions satisfied. First of all, one immovable property can be acquired and payment must be through proper banking channels, and there should be relevant inward remittance, and their marriage should be registered and it should be in existence for a period of 2 years or more, and that NRI or OCI spouse should not be prohibited from acquisition, and they should not use traveler check for the purpose of acquisition. Subject to these conditions, a person resident outside India together with his NRI or OCI spouse can acquire immovable property in India other than agriculture, those three. Hope this is clear. Next, diplomats, foreign embassies, they can purchase immovable property in India other than those three, agriculture, farmhouse, plantation. Other than those three, other type of immovable properties can be purchased in India by diplomats, foreign embassies, subject to two conditions. First one is there should be proper clearance from Ministry of External Affairs, and the funds must be paid through proper banking channels and inward remittance. Next, we have provisions related to ECB and exports. Those provisions we will see from PowerPoint presentation. First of all, we will complete this. After completing this, next we will see ECB and export provisions. By that the chapter gets completed. See, surrender of foreign exchange. First of all, the basic rule is whenever a person resident in India earns any foreign exchange, then that foreign exchange must be realized and repatriated into India, and it must be converted into Indian rupees from authorized dealer. This is the basic condition. And there is a concept of surrender of foreign exchange. What it says? Basically, here we can divide it into two parts. First one related to person not being individual resident in India, that means you can take Indian companies. And next one, individual being person resident in India. There is certain time limit given for the purpose of surrendering this foreign exchange. In case of person not being individual resident in India, if he acquires foreign exchange as a remuneration or as a payment for providing any services, then it must be converted into Indian rupees within 7 days from the date of receipt. Okay, it must be surrendered to authorized dealer and converted to Indian rupees. If in any other cases, if he receives foreign currency in any other cases other than as a remuneration for providing services, in that case within 90 days from the date of receipt, it has to be converted or surrendered to authorized dealer. Hope this is clear. Next, now for certain expenditure you might purchase foreign currency from the authorized dealer, and it might happen that you might not utilize entire foreign exchange purchased for that expenditure. In that case, that unspent portion of foreign exchange will be there, na, that has to be surrendered back to the authorized dealer. For this surrendering also there is certain time limits given. First of all, if you have acquired this foreign currency, you have purchased foreign currency for the purpose of travel, and there is some unspent balance left for going foreign travel, you purchased foreign currency, and in the foreign travel you are not able to utilize this entire currency, then after returning to India you have to surrender it back to the authorized dealer within 90 days from the date of return if they are currency notes, and within 180 days from the date of return if it is traveler check. And if the purpose for which you have purchased the foreign currency is other than foreign travel, in that case 60 days from the date of purchase of that foreign currency you have to return it or surrender it back to the authorized dealer. Hope this is clear. This is in case of person not being individual resident in India. Next, person being individual resident in India, in that case within 180 days from the date of receipt or realization of the foreign exchange you have to surrender it or you have to convert it into Indian rupees. Hope this is clear, through authorized dealer. Okay, now we will revise ECB and exports. By that our FEMA gets completed. Just a second. Now we will revise this exports and ECB from the PowerPoint. Generally, whenever you are exporting from non-EDI port, EDI means electronic data interchange. If you are exporting from a port where EDI facility is not available, you have to file a form known as Form EDF. And in case you are exporting services, you need to file a form known as SOFTEX. Now there is exemption from filing these forms in certain cases. Basically, there are around 10 cases given, like if you are exporting on a sample basis, or you are exporting for the purpose of repairs and maintenance, or you are exporting in order to replace. Okay, like this certain situations are given. If in those situations you are exporting, these forms need not be filed, the declaration need not be filed. And this is important, whenever you export, the amount of consideration must be realized and repatriated to India within 9 months from the date of export. And in case you are exporting for the purpose of warehousing, in that case within 15 months you have to realize and repatriate to India. Hope this is clear. And you will be requiring RBI approval specifically if you are exporting under this rupee state credit route scheme, or you are exporting under the credit line granted by Exim Bank of India. Hope this is clear. And in case you received any advances for the purpose of export, then you have to export the goods within 1 year from the date of receipt of advance. However, there is an exception. In case the agreement between you and the buyer itself specifies that a period of more than 1 year can be taken for the purpose of delivering the goods or exporting the goods, then in that case, since the agreement itself specifies a period more than 1 year, you can export in that within that period as specified in the agreement. Hope this is clear. Next, in relation to project exports, you will be requiring approval of approving authority. basically in case of project exports there will be the concept of a deferred payment. Okay, so you will be requiring a approval of approving authority, that is related to exports. Next, moving to external commercial borrowings. What are these external commercial borrowings? Generally there will be some eligible resident entities in India. These entities can raise loans, borrowings from recognized non-resident entities. This concept is known as external commercial borrowings. Here basically in relation to this external commercial borrowings we need to understand who are eligible resident entities, who are recognized non-resident entities, and what should be the average maturity period for the ECBs, and what is the all-in cost. If we understand these concepts, the ECB concept gets completed. Here I have given an illustration regarding ECB. In India there will be eligible resident entities. They will raise commercial loan from recognized non-resident entities. This is how ECB looks like. Now, bifurcation of ECB. Basically ECB can be bifurcated from two angles. First one, based on approval. Okay, based on approval ECBs will be of two type. One is automatic route, one is approval route. Generally in case of first of all we will see automatic route. If ECB that you are raising is up to $750 million per year, then no prior approval is required. You can directly raise under automatic route. If it exceeds $750 million per year, then you have to go through approval route. Hope this is clear. Next, based on currency. Okay, you can raise ECB either in foreign currency or in Indian rupee. Hope this is clear. Foreign currency denominated ECB, Indian rupee denominated ECB. Next, eligible borrowers. Who are eligible borrowers? Basically this eligible borrowers are different for foreign currency ECBs and for Indian currency ECBs. Let us see. For foreign currency ECBs, all entities eligible to receive foreign direct investments. Okay, all those Indian entities which are eligible to receive foreign direct investments are also eligible to raise external commercial borrowings. Okay, here I have given the list of entities which are not eligible for FDI. Okay, apart from these entities, remaining all entities are eligible for FDI. So apart from these entities, remaining all entities are eligible for ECB also. Hope this is clear. And entities which are established in SEZ, even those entities eligible to raise ECB, and port trusts are also eligible to raise ECB, and SIDBI and Exim Bank. These entities are eligible to raise ECB in foreign currency denomination. Now, all these entities can also raise ECB in Indian rupee denominated ECBs. And apart from those entities, even registered entities engaged in microfinance activities, even registered entities which are engaged in microfinance activities are eligible to raise Indian currency denominated ECBs. Hope this is clear. This is negative list for FDI, you can go through. And recognized lenders, we have seen who are eligible borrowers. Now, from whom these borrowers can raise ECB? See, first of all, the lender must be from the country which is compliant of FATF, that is Financial Action Task Force, or IOSCO, that is International Organization for Securities Commission Organization compliant country. Okay, the lender from whom you are borrowing must be from the country which is compliant of FATF or IOSCO. Hope this is clear. Next, you can also raise ECB from multilateral and regional financial institution. Example would be IMF, International Monetary Fund. Next, you can also raise ECB from foreign individuals, provided that foreign individuals who are giving you ECB must also be equity holders in your entity. Example, if Reliance Industries wanted to raise ECB from foreign individual, let's say Mark Zuckerberg, since Mark Zuckerberg invested in equity of Reliance Industries, it can rise from Mark Zuckerberg. Hope this is clear. Next, if you wanted to raise ECB from foreign branches of Indian banks, then you have to raise only foreign currency denominated ECB. Okay, you cannot raise Indian currency denominated ECB from foreign branch of Indian banks. Hope this is clear. However, those foreign branch of Indian banks can act as underwriters for raising the loan. Hope this is clear. Next, what should be the minimum average maturity period? Okay, maturity period means the period within which the ECB has to be repaid. Generally, it is 3 years. However, there are specific categories that are given. Let us see. Now, in the first row, I have given the purpose for which ECB is raised, and here you can find different categories like from whom you borrowed and what is the purpose of secondary loan and what will be the minimum average maturity period. Let us see. Now, purpose of ECB. If you have borrowed ECB for working capital and you have borrowed from foreign equity holder, in that case minimum average maturity period will be 5 years. And if you have borrowed for working capital and from others, then average maturity period will be 10 years. Next, you have borrowed for general corporate purposes from foreign equity holder 5 years, from others 10 years. You have borrowed for repayment of domestic rupee loans. Okay, actually you are already having some domestic loans. Okay, you have taken a loan from SBI, let's say. Now, to repay this SBI loan, you are raising ECB. In that case, if you are raising ECB from foreign equity holder, it is 5 years. If you are raising from others, then there are two bifurcations. Here you have to check what is the purpose of secondary loan. What is meant by secondary loan? Secondary loan means the loan which you are repaying. That means you are raising ECB for the purpose of repaying the loan that you have taken from SBI. Now, what is the purpose for which you have taken loan from SBI? If you have taken loan from SBI for capital expenditure purpose, then it is 7 years. If you have taken that secondary loan for other than capital expenditure purpose, then minimum average maturity period will be 10 years. Next, purpose of ECB is on lending by NBFCs. Generally, what some NBFCs they'll do is they will raise ECBs, okay, huge amount of ECB from foreign country, okay, because they will get the amount at a lower rate of interest, and this amount which they have raised as a ECB, they will give as a small loans to the domestic people. This is known as on lending. Okay, in this case, the secondary loan becomes on lending. Now, from whomever you raise ECB, and the purpose of secondary loan is for working capital. Okay, secondary loan means the on lending by NBFC is known as secondary loan in this case. If you are on lending for working capital purpose, then minimum average maturity period is 10 years. If you are on lending for corporate expenditure purpose, then 10 years. On lending for capital expenditure purpose, 10 years. On lending for other than capital expenditure purpose, 10 years. Okay, this is minimum average maturity period. And what can be the maximum all-in cost? Next, exchange rate. If you wanted to convert ECB, foreign exchange ECB into Indian denominated ECB, then what should be the exchange rate that you have to take? Okay, the rate that is prevailing on the date of such conversion agreement that you have to take. And hedging provisions, basically these hedging provisions are applicable only for infrastructure companies, and they have to hedge at least 70% of their ECB. Hope this is clear. And yeah, parking of ECB. Generally, once you raise the ECB, the entire amount you will get, but this entire amount you will not spend at a same time. Okay, you will be utilizing some amount at different times. So, till the time entire amount is utilized, you have to park this ECBs. Okay, you have to deposit this ECBs in some investments. Now, what are those types of investments in which the ECB amount raised can be invested? Let us see. See, if the purpose of raising ECB is to spend in foreign currency only, okay, you have raised foreign currency ECB and you wanted to spend in foreign country only. In that case, it can be parked in deposits of bank rated not less than AA negative, or treasury bills, or deposits with foreign branches of Indian banks. Okay, if the purpose of utilization of ECB raised is to spend in that foreign currency only, in that case, in these three investments you can park those ECB. If you are willing, or if you wanted to spend the ECB raised in the Indian denominated expenditure, okay, you raised ECB in a foreign currency and you are willing to spend it in the Indian rupees. In that case, you have to bring them back to India and you have to convert them into Indian currency and you have to keep them in term deposits of authorized dealer 1 category banks for a tenure of less than 12 months. Hope this is clear. Next, there are certain special cases. ECB by oil marketing companies. For ECB raised by oil marketing companies, the minimum average maturity period must be 3 years and overall ceiling that they can raise, okay, is $10 billion. That is the maximum amount of ECB that they can raise, and no hedging requirement is there. Next, ECB facility for startups. They can raise ECB with minimum average maturity period of 3 years and the lender must be resident of FATF compliant country, and the currency you can raise either in freely convertible currency or in Indian rupees, and the limit is $3 million. Okay, and whether an entity which is under investigation as per FEMA can raise ECB or not. The answer is, even though the entity is under investigation as per FEMA, it can raise ECB, but while raising ECB it has to communicate to that particular authorized dealer stating that there is a particular investigation that is going against me. Okay, by just making the declaration you can raise ECB, there is no issue. And if your entity is in the process of restructuring or in the process of IBC, okay, a corporate insolvency resolution process is going on, in that case you can raise ECB provided the resolution plan says that you are permitted to raise ECB. Hope this is clear. This is the revision of FEMA. Okay, I have tried to complete maximum concepts. Still we have some concepts like authorized dealer and some penalties and some miscellaneous sections that you can go through. Okay, by this I am winding up this class, and in case if you wanted to purchase regular classes, you can visit our website lecturepedia.in and you can purchase regular classes. Okay, take care, bye bye.